Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we're dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we'll be talking about using a fixed stop loss when you trade and whether it is the right or wrong approach to trading. Now, usually on the trading forums that you see out there, there's Baby Pips, there's Forex Factory, there's all these different forums, right? And in the forums, there are usually some trading strategies that people are always talking about. It could be moving average crossovers, it could be MACD crossovers, it could be stochastic RSI. There are all these different trading strategies out there, right? And one of the common things you tend to find when you look at these trading strategies is it gives you an entry condition and it gives you an exit condition, right? It says that, all right, when there's a moving average crossover, you enter into, for example, enter into a buy trade. And where do you put your stop loss? Put your stop loss like 30 pips away. You put your take profit 30 pips away, right? And you let the trade run. Now, there is a problem with this approach, right? And the problem is that firstly, from an institutional trader's perspective, is that 30 pips, if you're going to use the example of 30 pips, or some people like to use 100 pips, right? If you see something like this, right, you immediately need to know that the red flags, the warning bells should be sounding, because this guy, probably the creator of this strategy, probably doesn't know what he's talking about. Right, so that is the first way you can use to kind of filter whether this trading strategy is going to, might work or might not work, right? But the very fact that they're going to use a fixed stop loss is, it naturally kind of puts you on the should put you on the side of caution, right? Because 30 pips on euro dollar is going to be very different from 30 pips on pound dollar, and it's going to be even more different when you're comparing 30 pips on pound Aussie. Right, or it's the different asset classes, right? And on euro dollar, 30 pips might take you a longer time to reach compared to maybe pound Aussie, where it's very volatile. 30 pips can be something reached in a really, really quick amount of time, right? So the problem with fixed stop losses in this case is that it doesn't factor in, right? Firstly, the variability of the volatility of the instrument, but that alone is not the main problem, right? That is, firstly, of course, it is a big problem that the stop every market, every asset class behaves differently, right? 30 pips on, like I said, euro dollar is different from 30 pips on Aussie dollar, right? So, but that is not the main problem. The bigger problem with a fixed stop loss is that it does not take into consideration what the market, what's happening on the market. Right, it doesn't take into consideration what is happening on the market. Now let's try to paint a picture here, because this is a podcast, right? So just gotta use my words to paint a picture, right? So imagine, right, you have a bullish moving average crossover. So what does that mean, right? That means you see a moving average crossover and it tells you to buy, right? It tells you to buy, and then it tells you, okay, time to put your stop loss, right? Where are you gonna put your stop loss? Put your stop loss 30 pips below your entry. Okay, 30 pips below your entry. So you look at the charts, right, and you put your stop loss 30 pips below. And what you realize, right, you're just looking at the charts, you zoom out a bit, and on IronFX there's MT4, MT5, looking at the charts, and you're like, okay, I'm putting my stop loss 30 pips below, and this coincidentally happens to be a major support level. Right, every time price reach this 30 pips, roughly where we're going to put our stop loss, every time price reaches this level, right, price tends to bounce up. Price reaches the level, tends to bounce up, reaches the level, tends to bounce up, right? So that's what I call a strong support level. Okay, and you're putting a stop loss right at that level, or maybe even slightly before that level, right? So we've all seen it happen before, right? When we're trading, price drops down, it touches your stop loss, right? And then it just goes back up in the original trade direction, and you feel like, oh man, wow, is there market manipulation in this world? And how would they know that my stop loss was there? And why would I get stopped out and then the price just moves in my direction? Is the universe against me or something, you know. Yeah, we've seen that happen so often, but you know, it's not a case, right? From an institutional trader's perspective, right? It's not a case of the market, you know, having its own different plan for you, or is plotting against you. Instead, it's actually a case of stop loss placement, right? It's actually a case of stop loss placement, because when you're trading, your stop loss, right? We have this rule: take profit before, stop loss beyond, right? You want to put your stop loss beyond a key level. Okay, let me repeat that again. Okay, let me repeat that again. You want to put your stop loss beyond a key level. And why that happens is because in this example, right, if 30 pips is a major support level, you want to actually put your your stop loss maybe at 35 pips, maybe at 40 pips. You want to put it slightly beyond. Now, the reason for this is because you want to give your stop loss, or you want to give your trade that little bit of breathing space, right? That little bit of breathing space, right? So when you put your stop loss, like for example, imagine 30 pips that we talk about, right? The 30 pip stop loss distance is right at a major support level. When price reaches a major support level, what is likely to happen? It is likely to bounce, right? It is likely to bounce. So if you put your stop loss right at that level, you know, you're going to see it get touched, you know, price is going to touch your stop loss and it's going to bounce, and you're going to be thinking, wow, you know, how did the market know that I placed my stop loss there, right? And then it stopped me out and just, you know, go in the original direction of my trade, right? It's not that the market knows, it's just that the market is attracted to these key support levels, right? We actually have a term for it. Is we usually call it magnetic levels, right? That means why we use the term magnet is because the market is attracted to these levels. When the market is approaching a key support level, it tends to be attracted to that level. And if you happen to put your stop loss right at that level, that is where you will notice that, all right, the market is going to stops you out very frequently, right? And therein lies the danger of having a fixed stop loss, right? So when you have a fixed stop loss, you're not looking at what the market is telling you. The market is telling you there's a major support level here. I am very likely, you know, if I'm reaching that level, I'm very likely to approach it. I'm very likely to test that level. And if you put your stop loss right at the level, you are likely to get stopped out, right? So you actually want to put your stop loss slightly beyond, right? So it's not just a case of putting your stop loss slightly beyond, but it's more of a case of having an appreciation of what the market is telling you, right? The market doesn't care that, you know, some guru on some funny trading forum actually said that you're gonna use a stop loss of 30 pips. You know, they're not gonna approach your stop loss, right, and suddenly say, whoa, wait, there, you know, this is, we're reaching the 30 pip stop loss, you know, we're not allowed to do that, you know, we're not allowed to do that, and that's why we're going to reverse now and not stop this guy out, right? They don't care about that, right? They don't care about that. They're just gonna, the market doesn't care what you think. The market can stay irrational longer than it can stay liquid, you know, that's a popular saying, right? So my one so-called recommendation is that when you are placing your stop loss, sure, you can use the fixed stop loss as a gauge, right? As a rough estimate that, all right, I'm going to put my stop loss roughly 30 pips, all right? But if I notice that 30 pips happens to line up at a key level where the market is likely to test, maybe I need to move it to 32 pips. Maybe I need to move it to 35 pips. I need to tweak it a bit, right? So what I'm actually saying is that, you know, you use that variability, right? You use that variability in your stop loss, right? And that is a better approach to trading. So long answer to a short question on whether, you know, using a fixed stop loss is the right thing to do. No, it is the wrong thing to do, but instead the right thing to do is to use it as a rough gauge, as a rough estimate on where you should be placing your stop loss. Anyway, guys, that's it from me for today's podcast on using a fixed stop loss in your trading strategy. Do remember to subscribe to our podcast, as here at IronFX, we're dedicated to bringing you the very best trading education to take your trading to the next level. Until then, stay safe, trade safe, and peace out, guys.